Michael Burry is famous for being right when it comes to the markets. He called the 2008 financial crisis before anyone else. But now, in 2024, he has sold 40% of his portfolio. And I don't mean just a couple of stocks, almost half of his entire portfolio. That's a pretty big deal. So the real question is, why would he do this now? What's going on behind the scenes? Could this be a signal that a crisis is brewing? Is he expecting a market crash? Or is he just positioning for something big that we all might be missing? For someone with a track record of being ahead of the curve, pulling the trigger on something this big, you've got to wonder, what's coming next? Here's what I'm going to do. Break it all down. What exactly did Burry sell? And more importantly, why? What does this mean for the rest of us? Could this be a huge warning or maybe a chance to get ahead of the curve? Stick around. Michael Burry's journey in the financial world is one of the most fascinating ones. From his beginnings as a physician to becoming one of the most well-known hedge fund managers in the world, claiming what at the time even the government finance advisory could not understand.
Credit derivatives on an underlying asset could be worth multiple orders of magnitude more than the asset itself is worth, because all asset-backed securities, all asset-backed derivative securities settled in cash, pay as you go. That was the secret sauce of the doomsday machine. And so the crisis unfolded, with the market providing a signal far too late. Even so, Fed Chairman Ben Bernanke, Treasury Secretary Hank Paulson continued to underestimate the situation. I was just like that, apoplectic. Secretary Paulson now claims that even if he knew what was going to happen, he couldn't have done anything about it.
Despite having no formal finance background, Burry's keen ability to spot mispriced assets led him to achieve incredible success. His most famous bet was against the subprime mortgage market before the 2008 financial crisis, a move that ultimately earned him millions as well as fame in the financial world. Burry's investment style is highly unconventional. He tends to make contrarian bets that go against the consensus, driven by deep research and an ability to see risks others might ignore. He was able to see beyond the noise of the market and understand the technical flaws in mortgage securities, which was a key factor in his success. He knew about the growing risk in subprime mortgages and bet against them. Burry positioned himself ahead of the disaster that would unfold in the years to come. This was just one example of how Burry's approach to investing, rooted in deep analysis and skepticism, made him a standout figure in the financial world. And with his recent stock sell-offs, many are now wondering what is driving his decisions. Has Burry's strategy evolved, or is he once again seeing something others are missing? When it comes to why Michael Burry sells stocks, his reasons are grounded in a clear, disciplined approach to investing. One of the primary reasons he may decide to sell is when he believes the stock has become overpriced. Burry has always been willing to bet against the prevailing market sentiment, especially when it comes to overinflated assets. Just as he did with the housing market before the 2008 crash, Burry is quick to act when he spots a bubble. This is a hallmark of his investment style, a relentless pursuit of value and a willingness to take contrarian positions when the market is overly optimistic.
Soon, I would see financial Armageddon with housing as its trigger point. Now, in predicting when and how the collapse would occur, my focus was again on the actions of our government and the response of the private sector.
In this clip, Burry reflects on his past, specifically how he saw the risks within the housing market before it was widely acknowledged. His ability to spot overvalued assets like subprime mortgages and the government and private sector's response to it allowed him to make massive returns when others were blind to the risks. His focus on weak fundamentals and unsustainable growth was at the heart of his strategy when he decided to short the market. This strategic insight is not only key to understanding his past successes, but is also crucial when considering his recent sell-offs. Another major reason Burry sells stocks is when he feels the future prospects of the business or sector no longer align with his investment thesis. This was evident in his decision-making process when he adjusted his positions or completely pulled out of investments, especially when he perceived significant changes in the economic environment. When the growth potential of a stock begins to look bleak or the fundamental factors that once justified his investment no longer hold up, Burry's instinct is to divest. Both of these reasons, overpricing and weak future prospects, have guided Burry's decision-making process in the past, and they are likely influencing his recent stock sales as well. Whether it's due to a market that has become overvalued or companies with weakening growth potential, Burry's sell-offs are a direct reflection of his analytical approach to investing, which often involves stepping away from positions when the fundamentals no longer make sense. Looking at Burry's recent stock sales, we can start to notice patterns that align closely with his long-established investment philosophy. Over the last few quarters, Burry has sold or reduced positions in several high-profile companies, including Alibaba, JD.com, and Molina Healthcare. Let's break these down and see how they fit into his broader strategy. First, Burry made the decision to sell Alibaba, one of his largest holdings. He reduced his position by 25%. This is significant, especially considering the stock's past performance and Burry's history of holding on to positions for the long term. So, what drove this move? It seems that the combination of overpricing and a weakened outlook for Alibaba's growth prospects led to his decision to sell. At the time of Burry's sale, Alibaba had experienced a major surge in price, rising significantly in a short period. Just a quarter earlier, the stock had been extremely undervalued, presenting a buying opportunity. However, in the span of just one quarter, the price had risen so high that Burry likely felt it was the right time to lock in his profits. His decision fits perfectly into his strategy of recognizing when a stock is overpriced, even if that's after it has already experienced a significant run-up. Additionally, Chinese tech stocks, including Alibaba, have faced mounting regulatory pressures from the Chinese government. These regulatory crackdowns have created uncertainty about the future of these companies and have put a damper on their long-term growth. Burry, known for being cautious when a company's future prospects become uncertain, likely saw this as a signal to step back. The volatile environment surrounding Chinese tech companies may have raised concerns about Alibaba's ability to sustain its growth, leading to Burry's decision to sell.
We never quite achieved the catharsis necessary to stoke a deep reevaluation of our wants, needs, and fears. Importantly, the toxic twins, fiat currency and an activist Fed, remain firmly entrenched, even more so with the financial reforms last year. In fact, the Federal Reserve, having acquired new powers of regulation, has insisted specifically that nothing in the field of economics or finance was of any help in predicting the crisis. Period. No more comment.
This clip, although focused on broader economic concerns, closely aligns with Burry's approach to evaluating individual companies. Over the years, Burry has consistently sold stocks when he believes that the broader market or economic environment presents too many challenges for a company's growth. For Alibaba, the mounting pressures from both domestic and international forces could have been the catalyst for Burry to reduce his exposure. The combination of regulatory crackdowns in China and rising concerns about its future growth prospects likely made him hesitant to hold on to the stock any longer. Similarly, Burry sold JD.com, reducing his position by a significant 40%. Like Alibaba, JD.com, another major Chinese e-commerce giant, is dealing with similar challenges. The company is facing regulatory headwinds along with growing competition from other players in the market. On top of that, China's slowing economic growth presents an additional layer of concern for the future of JD.com's business. Another significant sale in his portfolio was Molina Healthcare, a company Burry reduced by 16.67%. Healthcare is a sector that Burry has been watching closely, especially with all the ongoing changes to the U.S. healthcare system and the uncertainty surrounding potential regulatory shifts that could have serious implications for companies in this space. Let's zoom out and look at the bigger picture. What do these actions mean for the market at large, and how should investors interpret Burry's moves? Burry's sell-offs could be more than just a series of individual decisions. They could be indicative of broader economic signals. Given his reputation for predicting major financial events, including the housing market collapse in 2008, it's natural to wonder if he is seeing something others are missing. For example, by cutting his positions in stocks like Alibaba and JD.com, Burry could be signaling that he expects a slowdown in Chinese markets. Chinese tech companies like these two have been rising quickly, but they're now facing increasing regulatory pressures from the Chinese government. This could suggest that Burry is warning investors to be cautious about overexposing themselves to these high-flying Chinese stocks, which are no longer the safe bets they once were. The writing may be on the wall, the regulatory environment is tightening, and that could make the future for these companies much less certain. Burry's actions could also be interpreted as a cautionary signal for global markets. As he has stated in the past, he closely monitors the interplay between government actions and private market responses. In a broader sense, this is about understanding systemic risks. The fiat currency, an activist Federal Reserve, and ongoing easy monetary policies are factors that could exacerbate market bubbles or create distortions in asset pricing. Burry's reduction in holdings could be a way of positioning his portfolio against potential systemic shocks. Now, let's zoom out even further. Burry's actions also seem to suggest that he's anticipating a shift in global economic sentiment. Over the last decade, easy monetary policies and low interest rates have fueled a stock market rally, making it seem like the economy was always on the rise. But now, with inflation creeping up and central banks starting to pull back on their stimulus measures, the economic environment is changing. Burry's moves suggest that he might be positioning himself for a potential market correction, a time when overvalued stocks and certain sectors could experience a significant pullback. This wouldn't be the first time Burry has acted based on a big-picture concern. His 2008 prediction was driven by a similar read of the economy, where he saw a bubble forming and knew it was about to burst. In many ways, this signals the caution he exercised leading up to the 2008 financial crisis. Burry is clearly trying to mitigate risk in his portfolio. He's been adjusting his holdings, perhaps preparing for a time when certain investments won't hold up. If the economic environment changes, he wants to be in a position where he's not heavily invested in areas that could struggle. Whether or not his predictions will come true, his history of accurately predicting crises makes his moves worth paying attention to. Even Warren Buffett, who has always recommended everyday investors to buy the S&P 500, has himself sold off his stake in the S&P 500. Click the video on screen to find out why.